Support for today's episode comes from Amazon. Amazon is working toward a carbon free energy future, doing more with less, investing where it matters most, and supporting communities where we operate. H2 projects will look different than what was planned in Q1. The first half of 2026 produced a growing divide between the projects companies wanted to build and the projects they can realistically execute. That distinction matters more than many planning models acknowledge, and it's reshaping how capital moves in the second half. When annual plans were finalized late last year, most organizations evaluated projects through familiar lenses: expected returns, strategic importance, market demand, and available capital. Those factors still matter, but as the year progressed, a different set of filters began exerting greater influence over which projects moved forward and which ones stalled. Power availability, water access, permitting certainty, equipment lead times, labor availability, interconnection timelines. None of these constraints are new individually. What changed during the first half is that they began arriving together more reliably on more projects in more markets. The result is a second half where the projects most likely to advance are not necessarily the ones that looked strongest on paper in January. They are the ones that fit the operating conditions of June. Project selection is shifting from returns to execution. Feasibility. Organizations rarely announce that they are changing how they prioritize investments. Yet many are already doing exactly that, and the evidence shows up in which projects are advancing and which are quietly being deferred. The clearest example is in energy-intensive infrastructure. Nixon Peabody's May 2026 data center site selection update described a market that has shifted to a power plus permission model where power access alone no longer determines viability. Regulatory readiness, utility relationships, community acceptance, and legislative risk at the state level are now equally determinative of whether a project moves. More than 300 bills were filed across 30-plus states in 2026 related to data center development, with many focused on water use, energy demand, and disclosure. The permitting environment itself has become a project variable, not a background condition. The same dynamic is emerging in manufacturing, logistics, and industrial operations. A project with exceptional projected returns still creates no value if it cannot secure power, obtain permits, source equipment, or begin construction within a realistic timeframe. As datacenters.com observed in February 2026, sites that fail readiness tests do not wait in line. They fall out of contention entirely. Demand moves to markets where readiness exists, and capital reallocates accordingly. The conversation is moving from which project creates the most value to which project can actually be delivered. Infrastructure readiness is becoming a competitive advantage across sectors. The organizations gaining the most flexibility in the current environment are often those with access to infrastructure secured years before the constraint environment arrived. Industrial sites with existing utility capacity, facilities with room for expansion, and locations with established permitting pathways are commanding premiums that weren't anticipated when those sites were acquired. Area Development's year-end 2025 analysis put it plainly. The era of easy expansion, where land availability and incentives could carry a project forward, has ended. What replaced it is a more infrastructure-driven reality, where success depends on early alignment among utilities, governments, communities, and capital. A site that appears more expensive on paper may ultimately prove more attractive if it offers shorter timelines and greater certainty. Conversely, a lower-cost location can be difficult to justify if infrastructure constraints delay deployment by years. The implications extend well beyond energy-intensive sectors. Manufacturing facilities, logistics hubs, water-intensive operations, and commercial developments increasingly face the same questions about infrastructure availability and timing. The projects moving forward are often the ones starting with fewer unknowns about power, permitting, and execution sequence. Capital is becoming more selective, not more cautious. The narrative surrounding capital markets in 2026 often reaches for the word caution. A more accurate description is selectivity. Significant capital remains available. EY's Q1 2026 Private Equity Pulse reported 13 deals announced in the utilities and energy space in Q1 alone, with an aggregate value of $67 billion, the most in a single quarter on record. Investors are not retreating. They are focusing on high-quality, well-structured deals in asset-heavy sectors where cash flows are visible and inflation-linked. The challenge is that investors, lenders, and boards are increasingly scrutinizing whether projects can realistically move from approval to operation. Projects dependent on multiple uncertain approvals, unresolved interconnection timelines, or speculative permitting outcomes face a higher burden of proof than they would have 2 years ago. Data Center Frontier's 2026 trends analysis captured the shift. Capital remains available, but it is more selective, rewarding projects that demonstrate power certainty, flexibility, and credible paths to sustained utilization. Meanwhile, projects with demonstrated site readiness and achievable timelines are attracting attention even in uncertain markets. The issue is not whether capital exists. The issue is whether the project can convert capital into execution. Optionality is replacing optimization as the design principle. Many organizations spent the past decade optimizing for efficiency, lean supply chains, single-source procurement, tightly sequenced project timelines. Those approaches created cost advantages when conditions were stable. They create vulnerabilities when conditions aren't. Today's environment increasingly rewards optionality. Projects designed around a single permitting pathway, a single supplier, a single site, or a single timeline are proving more vulnerable than projects built with contingency plans and alternative pathways. Manufacturers are evaluating multiple locations. Energy buyers are pursuing diverse procurement strategies. Infrastructure developers are examining alternative project sequencing approaches. PwC's mid-year 2026 deals outlook noted that the strongest transactions this year are not dependent on interest rate cuts, GDP growth, or trade policy resolution. They are built with a clear strategic rationale that remains resilient across a range of macroeconomic scenarios. That same logic applies to projects. The ones most likely to succeed in the second half are often the ones built with flexibility rather than precision. The question that should be driving second half planning. For much of the past decade, executive teams focused on identifying the best projects. That remains important. But the more useful question heading into the second half of 2026 is different. Not which projects generate the highest return, not which projects align most closely with strategy, not even which projects have received funding. The question is, which projects remain viable after power constraints, permitting realities, infrastructure limitations, labor availability, and execution timelines are fully accounted for? That answer may not be the same as it was 6 months ago. That does not mean organizations should lower their ambitions. It means they should reassess the filters through which opportunities are evaluated. Because the projects that move in the second half are increasingly being selected by conditions on the ground rather than assumptions in a planning document. Those conditions have changed, and the project list should reflect that. Sustainability Soundbites Energy coverage is sponsored by Amazon. Visit the link in our show notes to learn more about Amazon's spotlight on energy. For sponsorship opportunities with Environment and Energy Leader, please reach out to a member of our team.